This is the difference between T20 and the test matches, right? So T20 is 20 overs, test match is 20 wickets for the winner. Maybe more than 50% of the investor base today, right? People who have opened new demat accounts is in the last 3 years post-COVID, 3-4 years, right? So those people have not seen the long-term behavior of markets. On the Forbes billionaire list of 400, you will hardly see any traders, okay? But you will see 100, nearly out of 400, more than 100 are long-term investment managers. The main thing which you have to look at is that you are owning a piece of a business. How reliable is it that they are going to do much higher revenue, sales and profits and cash flows?
Hi and welcome to this episode of OmniTalk. Today we are discussing about the market volatility. Last, I think, couple of months where market has fallen at times by more than 10%. And in last few trading sessions, we have seen markets rebounding strongly. And the sentiment and the confusion about markets, has taken a sharp turn in terms of, people were really, not able to get their head around, like, is it a bear market? Are we going to see further correction? And suddenly the sentiments are changing. So I think this is a point to kind of remind ourselves that why, a long-term outlook is important in the markets, and how to simply allocate capital, right? What is the right way to allocate capital? And we keep talking to investors and we keep getting this question at any point in time.
Absolutely.
So let's just try and revisit, capital allocation and the timeline, or trying to time the market. What is the right approach?
Yeah, so even before that, important point I want to point out is that maybe more than 50% of the investor base today, right? People who have opened new demat accounts is in the last 3 years post-COVID, 3-4 years, right? So those people have not seen the long-term behavior of markets,
right?
Which is maybe 3.5 years of upside. Then every year 10% correction more or less happens. Every 3 to 5 years there is a bear market which lasts for anywhere between 6-9 months to even 1.5 years. But they should be prepared for a 3-year bear market, right? That is why we say long-term investment is 3 years to 5 years. Second point is these people the new investors have not had time to understand whether they want to be traders or investors, right? They've learned something about trading, they've read somewhere influencers or some online varsity or online digital information, and they've mixed both the things. So a lot of them are cricketers as well, or followers. So this is the difference between T20 and the test matches, right? So T20 is 20 overs, test match is 20 wickets for the winner. Okay, so it's very different completely, and you can't use concepts from one to the other.
Right.
Some very few might be common, but usually the concepts are very different. So for a trader, a 10% down is very, very bad, right? He should have booked stop loss at somewhere between 1, 3, 5%, whatever, and been out. While for an investor, a 10% down market is extremely making what was, if they were a buyer at the earlier price, they should be a significant buyer at a lower price, right?
Absolutely.
It's like a 10% discount. Maybe 9 months or 1 year's worth of returns are you're going to get just like that, right? If the market goes back to the earlier level. So at that time, but somehow people behave the other way.
Right.
That if it's going down, I have to sell out, which makes sense for a trader because he might be leveraged or whatever. But if you are with your own money, it makes sense to look at discounts.
True. I think what you are trying to emphasize, like last 4-5 years, and many new investors have only seen the up market. Very little corrections here and there, while the market has rebounded very strongly after that. So there's a very near-term focus that has been set up, right? Exactly. And it's like it's a thing which rewards you very, very quickly.
Quickly.
And the whole focus of this segment is on near-term gains.
Yes.
And they expect their market should just keep going up, right?
Exactly.
Why is it falling? And it is very troubling. And as managers, you should know when it will stop falling and when it will start going up.
Right.
Uh, and I think it's futile to even think about such questions, rather finding, spending time on and getting answers for these things.
Right. I mean, so the point I always try to tell people to do their own research on as well is on the Forbes billionaire list of 400, you'll hardly see any traders. Okay. But you will see 100, nearly out of 400, more than 100 are long term investment managers. Okay. So that is the difference, that trading might create millionaires, but trading hardly creates any billionaire. So that is the way, that is the key difference, And by luck, you can have a lot of millionaires. And if they don't change their trading style to investment style after they made their million, they're going likely to go back to non-millionaires.
So fundamentally, what investors should be looking at?
So people look at the price movement, which we have already addressed, right? That they should not look at the price movement, or rather look at it as an opportunity when there is a fall. The main thing which you have to look at is that you are owning a piece of a business. So you have to ask the questions that, let's say there are 20 stocks in your portfolio or 30 stocks in your portfolio. Are those companies going to be doing significantly higher sales, profits and net worth 5 years down the line or not? How reliable is it that they are going to do much higher revenue, sales and profits and cash flows 5 years down the line? If you are convinced about that, then the question is, at a lower price, it's an even better deal. And you should be extremely happy that I got a 10% lower, right? And you don't know whether the market is going to fall by 5%, 10% or 25% or 30%. Nobody knows all this, right? So you have to just go by. So what you should do every time is not just note the price of the stock or the value of the basket at that point, but also open the fact sheet and see the PE ratio. And now if the PE ratio is lower, that means that you are likely to get higher returns than earlier investments, right? So you've done, let's say, 100 rupees earlier. You can do a little bit more, maybe 10, 15, whatever is the appetite. And if there's no appetite, just look at the fundamentals. If fundamentals are strong, that's about it,
So the focus has to be on valuations, and obviously if the market has fallen, you made sure everyone try and make sure that they're investing in fundamentally stronger companies which are growing, as you said, right? And the second element is the valuations. So if you're already doing your job right at finding mispriced opportunities, and if there is a market fall, obviously now you are getting that mispriced opportunity at even lower valuations.
And the holding period should always have been minimum 3 years from your first investment. Right. That is the other main point you need to do.
And from your continued investment date, right? So that holding period actually keeps rolling also, as you are allocating more capital, or you are remaining invested in that strategy.
Absolutely.
Great. So I think this last few months of volatility episodes are very strong in terms of reminding all investors to understand the basic nature of the equity markets. It's not just one chart going up and you feel happy about looking at your portfolio. Sometimes these hiccups are there, but people who can remain invested and go through these ups and downs, I think they are the wealth creators in long term. And this is what we want to keep re-emphasizing every time we talk to you. So thanks for joining us.
Thank you.